Welcome, viewers. Thank you so much for coming to watch the video today. We are absolutely thrilled to have you here.
Yes, a very warm welcome to you all. We're really glad you're here with us.
Today, we are exploring the PepsiCo Q4 2025 earnings call transcript. And the mission of our conversation right now is to extract the most important insights regarding the company's strategy.
Right, looking at exactly how they are handling all these rapidly shifting consumer habits.
Exactly. And ultimately, what it all means for you and the broader market.
I mean, it is a massive transcript to read through, but tells a really fascinating story about where the industry is heading.
It really does. But before we get into what the Wall Street analysts were asking, let's quickly summarize the company's prepared presentation.
You mean the prepared remarks they gave before the Q&A actually began?
Right. Highlighting the key financial results, their guidance, and the strategic comments. Let's keep it concise, but make sure we cover all the major points.
Sure thing. So, on the financials and guidance front, PepsiCo told investors to expect balanced earnings per share throughout the year.
With sales really strengthening in the second half, right?
Yes, exactly. And a crucial point they made is that the productivity gains they secured back in the fourth quarter of 2024 they're carrying over.
Which is huge because that extra cash is what's fully funding their 2025 investments.
Precisely. Plus, their international business is expected to maintain its consistent mid-single-digit growth.
Now, regarding their strategic comments, the core theme they kept repeating was scaling affordability and growth.
Yeah, they are utilizing what they call a multi-vector strategy.
Which basically means they're pulling every operational lever they have.
Right, leveraging productivity to fund commercial plans and working to right-size Frito-Lay globally.
And on top of that, they're investing heavily in restaging their massive core brands. It's a huge undertaking.
Which naturally leads us right into the Q&A session because that's where the executives really had to defend those plans.
Absolutely. So for each question, we'll give you the analyst's name, their firm, a brief summary of their question, and then summarize the company's response to that question.
Perfect. Starting off, we had Bonnie Herzog from Goldman Sachs.
Her question was basically about how this accelerated affordability strategy is going to work in the first half of the year.
She wanted to know how low price points will actually go and how they can possibly balance that with profit margin expansion.
And the company's response didn't mince words. They basically said, we are playing offense.
I really love that phrasing. They explained the investments are manageable and highly surgical.
Meaning they aren't just slashing prices across the board. They are targeting specific brands and channels where affordability is a major friction point for low and middle income consumers.
And because this is funded by that Q4 productivity we mentioned, it's already showing strong return on investment and volume returns.
Next up, we had Andrew Teixeira at JP Morgan.
He was asking for some color on the rumors floating around about a 15% price reinvestment.
Right. He wanted to know how they plan to mitigate tough Q1 comparisons and what the expected volume trajectory looks like.
PepsiCo's response was very clear. Frito-Lay is expected to grow volume, revenue, and margins early in the year.
But they clarified that the 15% figure represents a maximum discount, not a baseline.
Yeah, the investments will be highly targeted.
The huge driver here is going to be double-digit space gains for Frito-Lay, which are coming during the March and April store resets.
Then an analyst from Morgan Stanley stepped in with a follow-up to that,
asking for more detail on exactly which packages or brands are being used for this affordability push.
and what payback was actually seen from the late 2024 actions.
The company reiterated that the approach is highly surgical, and importantly, it's already been tested at scale.
The volume returns have been very good so far.
Because they've actively right-sized Frito-Lay, the flow-through of this additional volume provides great leverage and profitability.
Moving on, Lauren Lieberman from Barclays had a really great question about their advertising budget,
Yeah, because advertising was down double digits in 2025.
which is roughly $500 million. That's a massive cut.
So she asked point blank if it's going back up in 2026.
And the company's response was a definitive yes.
They explained they achieved great efficiency in 2025, essentially doing more with less.
But advertising will absolutely increase next year to communicate value to the consumer.
And to forcefully push innovation and drive top-line sales growth.
Then Filippo Faloni at Citi shifted the conversation toward organic sales.
He asked what specific drivers will push organic sales to the higher end of the guidance range in the second half of 2026.
PepsiCo responded that international growth will remain steady.
But the real acceleration will come primarily from North America.
Exactly. They are seeing continued momentum in beverages and improving trends in food. They specifically noted December was better than October.
Plus, those recent acquisitions we've seen will mechanically convert into organic growth in the second half of the year.
Which brings us to Peter Grom from UBS.
He asked about the learnings from recent innovations, like Naked Juice and Pepsi Prebiotic.
And how those learnings inform their path forward.
The company's response was that they are focused on two distinct dimensions right now.
First, restaging those massive core brands like Lay's, Tostitos, Gatorade, and Quaker.
And second, periphery innovation to bring totally new consumers in.
Like Naked leaning into a no artificials claim, which is successfully winning back young moms.
Along with a massive push into portion control, low sugar, added fiber, and added protein across the board.
Which ties perfectly into Kevin Grundy's question from BNP Paribas.
Ah, yes, the GLP-1 question. This has been a huge concern for food investors lately.
He asked exactly how PepsiCo is handling the broader adoption of GLP-1 weight loss drugs.
You would think a snack company would panic, but the company's response was very proactive. They assume broader adoption will definitely happen.
But they view it as a massive opportunity, not a threat.
Because their data shows GLP-1 users stay in the category, they just eat smaller portions.
And over 70% of PepsiCo's U.S. food portfolio is already single-serve.
On top of that, they are heavily innovating around specific GLP-1 needs, pushing hydration with Gatorade and Propel,
Fiber for digestion with Quaker and Sun Chips.
plus adding protein and even developing snacks for new cooking methods like air frying.
Camille Gargiola from Jefferies then shifted the focus back to physical stores.
She asked where exactly these double-digit shelf space gains are actually coming from in grocery stores.
Because stores are already packed tight, the company explained the gains are across both the main snack aisles and the store perimeter.
Increased unit volume, driven by that affordability push, means stores literally need more physical capacity.
Just to fulfill both the everyday in-store shoppers and the booming online pickup orders.
Then Michael Lavery at Piper Sandler asked about their marketing strategy.
Specifically, what exactly is changing strategically with the marketing and innovation for the biggest brands like Lay's?
The company's response introduced a fascinating concept they are calling kitchen logic.
They are completely shifting the public perception of these heritage snacks.
The Lay's global relaunch features new visuals centered on nature and simple ingredients,
Moving to avocado and olive oils,
Yeah.
and totally eliminating artificials.
and elevating the stories of the actual farmers who grow the potatoes.
Over on the beverage side, Steve Powers at Deutsche Bank had a question about the North America beverage segment.
He asked how it will grow and specifically how the energy drink portfolio is performing right now.
PepsiCo said their main focus is on competitiveness in soft drinks and functional hydration.
Aiming for continued margin improvement overall.
But they said they are absolutely thrilled with the energy segment. It's approaching a 20% portfolio share.
Through a mix of their distribution margins, their Celsius ownership, and the highly successful integration of Alani Nu.
Peter Galbo at Bank of America followed up on those exact acquisitions.
He asked when the recent M&A deals actually flip over to be counted as organic growth.
The company's response laid out the timeline clearly. Poppy flips around March or July.
And Alani Nu flips toward the end of the year.
Which is exactly what will provide that noticeable boost to organic growth metrics in the back half.
Chris Carey from Wells Fargo Securities noted that brand Pepsi had a really great year.
He asked what went well for Pepsi and how Mountain Dew can replicate that success.
The company responded that Pepsi succeeded via the Pepsi Zero Challenge, where they were winning blind taste tests and through food pairing campaigns.
Mountain Dew is tougher, though, because it's a highly localized brand requiring segmented, granular marketing.
Though innovations like the Baja Blast expansion are doing very well, and they fully expect 2026 to be better than 2025 for Dew.
Robert Muscat at TD Cowen asked for an update on logistics, specifically a test in Texas and Florida.
That's where food and beverage distribution networks are actually being merged.
The company responded that initial numbers are very positive for the integrated delivery and inventory points.
Showing much better cost efficiency and improved customer service for retailers.
It does require complex new IT systems and vehicle innovations, though.
And while it won't be a one-size-fits-all model rolled out across the entire U.S., it will unlock significant value.
Finally, Robert Odstein at Evercore ISI asked about the big macro picture.
What are the underlying macroeconomic expectations supporting all of the company's guidance.
The company's response is that the guidance assumes a continuation of current economic trends.
The U.S. lower and middle income consumer remains stretched and highly choiceful,
Looking internationally, Mexico, China, and the Middle East look positive.
while Western Europe is a bit weaker and Brazil is remaining neutral.
So, to provide a high-level wrap-up of the main themes from both the presentation and the Q&A session,
Please do.
PepsiCo is aggressively but surgically adjusting prices to drive unit volume and secure massive shelf space.
Right.
At the exact same time, they are totally reinventing the image of their flagship snacks with things like avocado oil and kitchen logic.
And they are masterfully pivoting to the GLP-1 era with a heavy focus on single-serve portions, fiber, and hydration.
They are actively adapting to consumer trends rather than fighting them.
Which leaves you with a final provocative thought to ponder. Considering the shift toward avocado oils, kitchen logic, and the rise of GLP-1 medications, are we witnessing the total extinction of the traditional junk food aisle as we know it?
That is a wild thing to think about next time you're at the grocery store.
Thank you, viewers, so much for watching. If you liked the video, please make sure to click like, share the video, subscribe, and stay tuned for upcoming content.